speak to you briefly about the Millennial Generation. This is the generation between 1981 to 1996, north of 76 million of them. And then the second biggest generation that comes right thereafter, Generation Z, between the years of 1997 to 2012. So we're looking at the Millennial Generation, the age group of between the 23 years old and the 38 years old, and they are now getting into the prime years of spending. And we need to understand a little bit about that generation, because more and more of the investments we are going to do and we are doing caters to that generation. The number one thing about them is that they don't like to buy products. They like to rent products. Therefore, every company that is in the space of subscription model can work very well with that generation. And that includes technology firms, even companies like Apple computers. And that, in our view, will start moving into a subscription model more and more so, even for the phones they are selling. And that also includes many companies in the software business that do cloud business and provide us with everything that we need to maintain our lifestyle. Some companies that will be interesting to look at are big brick and mortar companies such as Nike, where they give you an opportunity to design the shoes that you wear. 78% of the Millennial Generation put most of their effort in buying products that are designed to their taste. The desired experience is super important for the Millennial Generation, and that's how they go mostly about shopping. The average millennial spends about $44 per month on a subscription model. 83% of them care a lot about corporate values, and 47% of them have college degrees, and they are extremely computer literate. This is why I think technology is going to do extremely well, because when these generational newcomers are going to start spending money, they're going to spend more and more so on technology-based companies. They understand technology, they understand how to use technology. But that said, those that are getting into their prime years are going to start buying homes. So companies like Home Depot can do quite well with that generation. And Home Depot is not terribly expensive company, selling at less than 20 times earnings. And Nike is another company that is on the more of the expensive multiple, selling at 33 times earnings. But the growth they are getting with their in-store design platform attracts a lot of these millennials. Some other technology companies that provide complete services online is software companies such as Zora. It's a fast-growing software company benefiting from the subscription economy that helps you to maintain, support everything you need, from spending money online to running your accounting books to keeping track on your spending on a monthly basis. So this is definitely a space we should look at and take it into account in a big way. I also wanted to talk about Google briefly. One thing about Google is that they are never really so clear about all their different businesses and how they generate income and revenues. It's all fine and good as long as you keep growing your business at 22 to 24% per year. But that wasn't the case last week, because for the first time, the revenue growth rate dropped below 20%. Google is now, per their last quarter reporting, is growing at about 17.5%. When that happens, investors start asking tough questions. And Google is not that great breaking down their different businesses, such as they don't speak much about their YouTube business. We all know that they are cleaning out that unit because they have some content they try to walk away from. The moment you clean out your platform, you start suffering advertisement shortfall. Investors are asking questions about. Another unit they don't mention too much is their cloud business. And we all know that this is an important integral part of what Google does. They also don't talk much about their different businesses or special situations businesses, such as the autonomous driving and other things that they have. With that said, when you don't get enough clarity from a company and revenues are dropping, you can see a drop in the stock of about 7%, as such that we saw last week. With all that in mind, the positives about Google are still in place. This is a stock that has a cash pile of about $109 billion in cash. They generate $23 billion in free cash flow. They are still growing at 17%, which is a lot more than what the typical average company or the S&P 500 grows, 5% or so. And they are not that expensive, selling still at 24 times earnings. And they have unbelievable businesses in their portfolio, such as autonomous driving, which they are launching service in San Francisco, Phoenix, Arizona, and New York. And there will be major competitors, in my view, to a company like Uber and Lyft. And we all know that their cloud business is still doing extremely well because we are just now scrapping the bottom of that market. This is a market in the trillions of dollars, and more companies are moving to the cloud. In fact, only about 10% of all companies are using the cloud to provide services. Take, for example, another company like Uber. They are going to come to market as an IPO this week. They want to price about $10 billion worth of shares. Their main business is transportation. For me, Uber is a glorified version of Lyft. And why is that? Because they are still losing about $1 billion a quarter. A company like that, I think, will face tremendous competition from robo-taxis that are going to come to market in the form of Waymo by Google and Cruise by GM. And that happens, I think their appeal is going to diminish even more so. So not only they have tremendous competition coming, and that's another reason why I like Google, they also are extremely expensive in my view. And we should be careful jumping into a company like Uber as opposed to Google.
I got onto this Vertex Pharmaceutical company through a friend of mine her daughter's looking at joining the company, so I decided to look at it. It's a very interesting company. They are focusing on cystic fibrosis drugs, and they have 3 drugs already in the pipeline and selling, and they mostly sell it in Europe right now. They're in final approval stage with the FDA, and they've already have generated revenues year over year. 2018 versus 17, they had 34% increase to $858 million. Earnings are $1.03, which is an increase of 27% over the previous year, and their income jumped 115% to $277 million. They're trading at a PE ratio of just a little over 20. So I thought that was a very good PE ratio for a company that's pretty young. They have a trifecta of drugs which they think will be used for the next stage of alpha-1 type of disorders in children. And they're focused on children between the ages of 6 and 12. They think that their usage can jump from 18,000 clients currently to 68,000. Their revenues, they're saying, looking forward, could go as much as $3.5 billion. That would be pretty much with the FDA approval in the United States. This is a disease that has been with us for a long time, and it's a death sentence to the children because basically there's no current cure for it.
I'm going to do a technology highlight today as I typically do. We are upon developer conference season. A lot of the technology companies are doing their developer conferences. These are often overlooked by a lot of the investment community, but very important for the outset of what the companies are going to do during the year. So this week, Microsoft is doing their conference called Build. Later in the week, also Google starts theirs. Google I/O is the name of their conference. And then last week, F8, which is Facebook's developer conference, kicked off. And then we know that Apple usually does theirs about the first week in June, and theirs is called WWDC, or the Worldwide Developers Conference. And these are conferences where the companies showcase their software and what the initiatives are for the year in terms of developers. They have what are called software development kits, SDKs, and they have all of the application and software functionality that developers use to access their hardware, operating systems, or whatever their software product may be. This week, Microsoft CEO Satya Nadella is actually showcasing the strategy of what Microsoft will do. There's no real details of what he'll go over or what he'll break, but he's going to focus on the Windows operating system, Office 365, and Microsoft 365. These are a place that we'll keep attuned of to figure out what is going on in these technology companies, again, because this is often the place where things are broken.
Okay, so just as a way of recap regarding the yield curve, we know that back in December of 2018, we had a temporary inversion of the 3-year and the 5-year, and that occurred again in March. The 3 to the 5-year has not inverted again. It stayed at about 2 to 3 basis points. The 2 to the 10-year is the more important indicator that we want to watch. That has not inverted. It got down to a low of 12 basis points, and it stayed pretty consistent around 21 to 23 basis points most recently. And just to keep in mind that the average inversion to recession period is anywhere from 12 to 24 months. So from the first inversion back in December of 2018, that would take us into the first quarter of 2020 before typically we would see any kind of a recession.
Hello everybody, and thank you again for watching our videos. I'm Amit Stavinsky, the Managing Director of Tamar Securities and its affiliates, 911 Financial Services and Firefighters United. If you like the videos, please sign up to our YouTube channel and become a subscriber. You can also reach us by calling us directly to our main offices at 818-914-7461. The highlight of the week is that not necessarily companies that become cheaper eventually will regress back to the mean and will be valued fairly by the market. It happens to be recently that sectors and companies that are going up will keep going up in some cases because we are facing a generational change in behavior.